The core principles of intelligent investing. Investing is often perceived as a path to quick wealth, but Benjamin Graham, in his classic work, The Intelligent Investor, challenges this notion by emphasizing patience, discipline, and rationality over speculation. His principles remain timeless, guiding investors toward financial security rather than short-term gains. At the heart of Graham's philosophy lies a simple yet powerful idea. Successful investing is about minimizing risk, protecting capital, and ensuring steady growth. Investment versus speculation. One of the most critical distinctions Graham makes is between investing and speculating. An investor seeks safety and adequate returns, relying on careful analysis and long-term strategies. In contrast, a speculator gambles on price movements, driven by market trends and emotions rather than logic. Graham warns that speculation often leads to losses because it prioritizes speed and excitement over security and sustainability. The margin of safety. A fundamental principle of Graham's approach is the margin of safety. This concept advises buying securities at a price significantly below their intrinsic value. Doing so creates a cushion that protects investors from errors in judgment, unforeseen market fluctuations, or economic downturns. By prioritizing safety over potential profit, investors reduce risk while maintaining the possibility of solid returns. Mr. Market and emotional discipline. To explain the market's irrational nature, Graham introduces the famous Mr. Market analogy. Imagine the market as a moody business partner who offers to buy or sell shares daily at varying prices. Sometimes he is overly optimistic. Other times, he is excessively pessimistic. The intelligent investor does not let Mr. Market's mood swings dictate decisions, but instead takes advantage of favorable opportunities when prices fall below intrinsic value. This requires emotional discipline, resisting herd mentality, avoiding panic during downturns, and staying rational when others act impulsively. Types of investors: defensive versus enterprising. Graham identifies two primary investor types: the defensive investor and the enterprising investor. The defensive investor prioritizes safety and simplicity, favoring diversification and passive strategies such as index funds. This approach suits those who lack the time or expertise for active investing. On the other hand, the enterprising investor dedicates time and effort to research, seeking undervalued stocks and bonds for higher potential returns. While riskier and more demanding, this approach can be rewarding for skilled, disciplined individuals. Diversification and inflation. Awareness. Diversification is another cornerstone of intelligent investing. By spreading investments across multiple securities, sectors, and asset classes, investors reduce the risk of catastrophic loss from any single failure. Furthermore, Graham stresses the importance of accounting for inflation, especially when dealing with fixed income investments like bonds. Inflation erodes purchasing power, so investors must balance their portfolios with assets that can withstand or outpace rising prices. The main takeaway. Ultimately, Graham's message is clear. Investing is not about outsmarting the market or chasing rapid gains. It is about protecting capital, ensuring steady growth, and avoiding major losses through rational, value-based decision-making. By adhering to principles such as margin of safety, emotional discipline, and diversification, investors can achieve long-term financial security without falling prey to speculation and hype. Please like, share, and subscribe. Thank you for watching.